Welcome back to the UK Mortgage Market Insights. It's the week ending the 5th of June 2026. Coming up, we've got Halifax House Price Index for May, and there are a couple of numbers in there that are worth talking about. We've also got fresh Bank of England data on mortgage approvals for April. Put the two together and you get an interesting picture of where the market actually is right now, and I'll give you my take on that towards the end of the video. We've got a clutch of lenders who've been cutting rates this week, including some decent moves from Accord on both residential and buy-to-let. I'll tell you what's actually driving those cuts because it's not quite the good news story that the headline suggests. And we're going to talk about fixed versus tracker mortgages. Should you be fixing right now, or does a tracker still make sense? I'll give you my honest opinion because it's a question I get asked on a daily basis. Swap rates as well. They've moved this week and not quite in the direction that you might expect given all the rate cutting that's going on. So if you find this useful, please do subscribe because it really does help the channel to grow and get the message out there to people that might just need it. So let's get into it. So this week has seen a decent run of rate reductions. Bank of Ireland have cut, Santander have cut, HSBC have cut, Coventry Building Society have cut, and Accord have been active on both sides, reducing their new business buy-to-let rates and cutting their residential rates by up to 0.46%, which is a meaningful reduction, especially considering that they have been out of the game for some time following their not so good service levels. Thankfully, they're now back on track and looking for business again. The Mortgage Works, the nationwide buy-to-let arm, have also made some reductions on some of their products as well. Now here's the thing about all this rate cutting, because it's the context that matters. If you don't understand that context, you could find yourself making the wrong decision. It's a bit like when you start Googling symptoms that you have, and before you know it, you're writing your own will. Now, margins are tight because of elevated swap rates, which we will come on to soon. But no applications coming in is worse than tight margins. So these lenders are bringing themselves back into line with the competition. It's competitive pressure, not generosity, and I think it's worth you knowing that. So let's look at those swap rates because this adds an interesting layer to everything that I've just said. Last week, 2-year swaps were sitting at 4.073 and 5-year at 4.103. This week, 2-year have barely moved, coming in at 4.070, essentially flat. The 5-year, though, has nudged up to 4.173. So while lenders are busy cutting rates, the 5-year swap has actually ticked upwards. This tells you that the rate cuts this week are about competitive repositioning. Not because funding costs have fallen, lenders are squeezing their margins to get back in the game because lenders who priced themselves too high killed off their own pipelines, and now they're scrambling back towards the middle of the market to get some business through the door. So the rate cuts are welcome, but whether they are sustainable is a whole other question. Now, the 5-year swap moving upward is worth paying attention to beyond just this week. The swap rate is essentially the market pricing in where it thinks interest rates are heading over the next 5 years. And when the 5-year is nudging up rather than falling, what that's telling you is that the market doesn't expect rates to drop away anytime soon. The reality is that we could be looking at mortgage rates staying broadly around current levels for some time yet. Now that's not doom and gloom, it's just the reality of where we are, and it's useful information if you're trying to decide whether to fix, how long to fix for, or whether a tracker makes sense for your situation. Now I'll come back to this a bit later. So moving on, the Bank of England published their money and credit data yesterday for April 2025, and there are some interesting numbers in there. Net mortgage approvals for house purchases came in at 65,900 in April. That's above the previous 6-month average of around 63,100. So on the face of it, the market looks active. Approvals for remortgaging were broadly unchanged compared to March. Net borrowing of mortgage debt by individuals fell to £4.4 billion in April, down from £6.8 billion in March, and that's below the previous 6-month average of £5.1 billion. So that means that people are getting approved for mortgages, but borrowing less. Make of that what you will. We've also got the Halifax House Price Index out this week, and it adds another piece to the puzzle. House prices edged down 0.1% in May according to Halifax data. That follows an identical 0.1% fall in April, 2 months of modest falls back to back. The average property price now sits at just under £299,000, down from just over £299,000 in April. we're hovering just below that 300,000 mark. Annual growth is up very slightly to 0.5% from 0.4% in April, so prices are still higher than a year ago, but only just. Now, Halifax's head of mortgages points to the Middle East developments as continued drag on price trends. Higher inflation expectations have kept borrowing costs above where they were at the start of the year, stretching affordability and cooling demand. And that's something I'll come back to in a moment when we look at what's actually happening on the ground. First-time buyer annual growth is even more subdued at just 0.3%. Getting on the ladder remains tough, though Halifax do note that lenders are offering more flexible affordability checks and a wider range of low deposit options, which is worth knowing if you're in that position. One regional standout though, Northern Ireland is recording annual growth of 7.8%, the strongest of any UK region by some distance. The overall picture from the Halifax is that prices are expected to remain broadly stable while interest rates stay elevated. No crash, no surge, just a market that's waiting for something to shift. And I think that's a pretty fair summary of where we are. Now, I want to give you some real world context on this because the numbers only tell part of the story. Now, we are genuinely busy. Enquiries are strong, decisions in principle are flying out the door, and the appetite to move is absolutely there. But actual mortgage applications for purchases, they've slowed down, and the reason is almost entirely about price. Buyers are out there, they want to buy, they are engaged and they are motivated. But when they go to make an offer, there's a gap. Sellers are still holding on to prices that made sense a year or two ago, and buyers are not meeting them there. And the Halifax data that we just looked at backs that up. 2 months of falling prices, annual growth of just 0.5%, and affordability stretched because borrowing costs haven't fallen back to where they were at the start of the year. The market is telling sellers something, but not enough of them are listening. You can see it in the stock levels as well. The people I'm talking to, buyers, agents, brokers around the country, they're all saying the same thing. There isn't enough new stock coming to market. What is on the market has largely been sitting there since the start of the year, a lot of it since before the Middle East tensions started pushing uncertainty back into global markets. When a property has been sitting on the market since before all of that kicked off and it still hasn't sold, that tells you something. And that is that sellers haven't adjusted their expectations to match where the market really is. Is it a good time to buy? Genuinely, yes. There are deals to be had. Motivated sellers who are realistic about pricing are doing deals. Buyers who are willing to negotiate and be patient are finding value. But sellers who are holding out for 2022 money, they need to get real. And until more of them do, you're going to keep seeing this gap between approvals data looking reasonable and actual completions feeling slow. For those of you that are looking to buy right now, I'd love to know if you're seeing the same in your area. Please drop me a comment below because I'd be interested to know whether this is just a London thing or if it's playing out right across the country. Right, fixed versus tracker, and if fixed, for how long? This is the question that I get asked more than almost anything else at the moment. Well, let me walk you through how I think about it because there isn't a single right answer. It really depends on your situation. The case for fixing is straightforward. You know exactly what you're paying, you can budget with certainty. If rates go up, you're protected, and right now, fixed rates, particularly 2-year fixes, are not bad. I mean, they'd been better, and the reality is if the war in the Middle East hadn't started, they'd be much better than where they are now, but with lenders cutting this week, there is decent value to be found, especially if you have a really good deposit or a large amount of equity for those that are remortgaging. 2-year fixes give you a shorter commitment time and the chance to reassess when rates may well be lower. With 5-year swaps nudging up this week, lenders pricing 5-year fixes might actually need to pull back a little rather than cutting further. So if a 5-year fix is on your radar, there is an argument for not hanging around and to make your decision sooner rather than later. The case for a tracker is that we are in a period where the direction of travel for the Bank of England base rate is largely unknown. We've already seen cuts and the economy needs more, but the risk with a tracker, of course, is that if something unexpected happens, global events, inflation spikes, whatever it might be, and rates go the wrong way, with a tracker, you feel that immediately. Trackers suit people who have the financial flexibility to absorb some payment movement, and who want to benefit if base rate drops happen faster than expected. They are not for people who are living on the breadline, people whose budgets are tight, people who really couldn't afford an increase. So just think about your decision before you actually sign on the dotted line. So what does all of this mean for you? Well, if you're coming off a fix in the next 3 to 6 months, now is a good time to be talking to a broker. Not because rates are at rock bottom, because they're not, but because lenders are actively competing for business right now, and that creates opportunity. If you're a buyer, the Halifax data this week is actually quietly encouraging. Prices have edged down 2 months in a row. Sellers are under pressure, even if a lot of them haven't fully accepted it yet. Be patient, be ready, and be prepared to negotiate. The buyers doing well right now are the ones who are pre-approved, know their numbers, and can move when a motivated seller turns up. And if you're a landlord, Accord and the Mortgage Works buy-to-let rate reductions are worth a look. It's been a tough couple of years for buy-to-let, so any genuine reductions in rates are worth reviewing against your current deals. My honest read of the market this week is that everything is pointing in the same direction, and that direction is cautious. 2 months of falling house prices from Halifax, mortgage approvals above the 6-month average but net borrowing down, swap rates suggesting rates aren't going to fall away sharply anytime soon, lenders cutting not because conditions are improving but because they need the business. The market is busy at the inquiry end and sluggish at the completion end, and the gap in the middle is almost entirely a pricing gap. Sellers who get real are doing deals. Sellers who don't are sitting on stock that listed before the Middle East situation, and they're wondering why the phone isn't ringing. For buyers who are properly prepared, this is genuinely a decent moment. Not because everything is rosy, but because motivated sellers do exist, rates are being cut, and you have more negotiating power than you did 18 months ago. The data and the reality on the ground are telling the same story this week. That doesn't always happen, so it's worth paying attention to it when it does. So who can benefit the most right now? Well, first-time buyers who are properly prepared. The Halifax data shows annual growth for first-time buyers is running at just 0.3%. Prices in that part of the market are barely moving. Lenders are also offering more flexible affordability checks and a wider range of low deposit options than they were a year ago. If you've got your decision in principle sorted, you know what you can afford, and you're working with a good broker, you're in a stronger position than you might think you are. Buyers who are ready to move quickly. With stock sitting stale on the market and sellers under quiet pressure from 2 months of falling prices, the balance of power has shifted. A proceedable buyer with finance in place is a valuable thing right now. Use that to your advantage. Remortgage customers coming off fixes in the next 6 months. Get advice early. Lenders are competing hard for business and there is value to be found. But the 5-year swap nudging up this week is a reminder that rates aren't necessarily going to keep falling. Don't assume that next month is going to be better, because it might not be. And landlords with properties on standard variable rates, with Accord and others cutting buy-to-let rates this week, there might be genuine savings available if you haven't reviewed your deal recently. It's worth a conversation. Well, that's everything from me this week. If you found it useful, please do subscribe. It genuinely helps the channel grow and it means more people get access to this kind of information every week. On that note, if there is anyone who you think might find it useful, please share it with them. I get a lot of people say that this kind of analysis is like nothing they've seen before, and that it genuinely helps them to understand the market better, and it helps them to make better financial decisions. So anything that you viewers can do to share that message really is greatly appreciated. That's it from me. Have a good weekend. I'll see you next week. Take care.